TSMC is about to report, and the real question is not whether the headline numbers look strong. The decision is whether this report confirms that the AI build-out still has durable demand, manufacturing capacity, and acceptable economics. They matter more than a single earnings beat. This is a conditional scenario model, not a prediction. The starting position is demanding. TSMC's April through June revenue reached about NT $1.27 trillion, 36% above the same quarter last year, while management had guided for second quarter revenue of $39 billion to $40.2 billion. First quarter HPC revenue represented 61% of revenue, and management said AI demand remained robust. Expectations are high. The market shock is the information inside the guidance, not the backward-looking profit number. Investors need to hear whether cloud customers are requesting more leading-edge capacity, whether advanced packaging remains tight, and whether TSMC will keep spending near the high end of its $52 billion to $56 billion capital budget. The report matters most when those signals move together. In the base case, TSMC delivers results close to elevated expectations, keeps full-year revenue growth above 30%, and maintains capital spending near the high end of its range. Demand remains strong, but management does not reveal a clear acceleration. Margins stay consistent with prior guidance despite overseas fab and 2-nanometer ramp costs. That would support the AI thesis without creating a new re-rating. In the bull case, management raises the growth outlook, signals that demand still exceeds available advanced node or packaging capacity, and commits to faster expansion without sacrificing margin discipline. That combination would suggest the spending is responding to customer demand rather than speculative capacity building. TSMC would become stronger evidence for Nvidia, semiconductor equipment, and the AI infrastructure trade. The key word would be alignment. In the bear case, the headline quarter may still look strong, but the forward signals weaken. Guidance could disappoint. Capital spending could become more cautious, or management could emphasize margin pressure from overseas manufacturing, new node ramps, materials, or customer concentration. That would create a damaging contradiction. Excellent historical revenue, but less confidence in the next stage of the build-out. AI stocks could face an expectations reset. The variable that changes everything is the relationship between incremental capacity and incremental profitability. Higher spending is bullish only when management can connect it to durable orders, high utilization, and healthy returns. Lower spending is not automatically bearish if productivity is improving, but it becomes concerning when it reflects weaker demand. The market must separate disciplined efficiency from fading conviction. This model cannot know the first market reaction because positioning and expectations can overwhelm the fundamental message. A strong report can still produce a sell-off when investors demanded perfection, while a mixed report can rally if the feared outcome was worse. Currency movements, Taiwan risk, interest rates, and later US economic data can also change the reaction. Price alone will not identify which scenario is operating. The practical framework is simple. Watch guidance first, then capital spending and capacity commentary, then gross margin resilience. A clean bull confirmation requires all three to improve or remain convincingly strong. A mixed combination belongs in the base case, while weakening guidance plus weaker investment confidence or deteriorating margins moves the evidence toward the bear case. The calm verdict is that TSMC can confirm the AI rally, But a record quarter by itself is not enough. Durable liquidity appears through customers funding more compute, TSMC converting that demand into capacity, and the company preserving returns while it expands. That is the evidence chain investors should follow after the report. This framework is educational, not a forecast or financial advice.